Hello and welcome to another video as part of the technical analysis series. First of all, I'd like to thank you for all the support on the video on timeframes. That was really cool to see, and I'm happy that you enjoyed that piece of content. As disjointed as it may be in the order of things, I'm sure that's something you're used to at this point in the channel. Today we're talking about using Overthrow for stop placement. If that means nothing to you, I'm certain if I've done my job correctly that it will at the end of this video, but roughly we're going to be talking about stop placement and how to make that portion of a trade easier, more rigorous, logical, and systematic. That's a lot of synonyms. So let's start the actual teaching. Outline, nothing too surprising. Disclaimer, general remarks, some general context as well on how markets are not clean and what that means for these types of setups or applying this logic to our risk definition. We'll then talk about defining risk at a level and the two kind of branches of taking a trade as a structure. Finally, we'll get to Overthrow and break that down into two parts. Part 1 being introduction and explanation, Part 2 being structures and elements, and then we'll also break stop placement down, having learned Overthrow, into two parts, specifically the two different ways in which risk can be defined using Overthrow. And hopefully those two categories will be clear, or at least familiar to those who have studied the support resistance trade setup video. Having done that, we'll do some probability enhancers, basically how to, avoid common pitfalls and make the most of these types of setups, and then conclude. Normal disclaimer, please pause the video, read it, familiarize yourself. I'm not a financial advisor, this is for entertainment purposes only, and I suggest we start the entertainment. So, general remarks. As mentioned in the beginning, this video builds on the concepts discussed in the support resistance setup video. Certain videos, because of the messed up chronology, there is kind of mandatory watching sort of content without which the video will make no sense. This is not one of those videos. I recommend you watch the support resistance trade setup one, but it's not mandatory. We'll still cover the same concepts from scratch. Now, something to bear in mind is there are two legs or branches when looking at a technical structure for a trade, and people tend to fixate on just one of these and leave the second one, arguably the more important one, to kind of chance randomness, or it's not really something that newer traders are systematic about. And so the first part is the obvious one. Does the structure itself qualify? So is the level good enough? Is the level clear enough? Does it have enough touches? Is the supply-demand zone significant enough? All these kind of rules around the technical structure itself. Nobody really ignores those, right? That's the kind of trade selection or structure selection is there's almost too much focus on that, if anything. So that's no secret, hopefully, to anybody. And then the second part, which is much more in the shade and doesn't get the attention it should, is not only is the structure itself good enough, but can I define my risk around that technical structure should I elect to trade it, right? So what does defining risk mean? And this is a term that will be ubiquitous throughout the video. Well, that is to say somewhere logical to place a stop-loss order when trading a technical structure, right? So if I've got a level that I think is superb, it needs to tick two boxes for that level, the structure itself, to morph, if you will, into a trade. Part 1 is the structure itself good enough? And then part 2 is, does it allow me, and does the surrounding price action around that structure allow me to define my risk well? Which basically means, again, logically and in a way that's replicable and so on. We'll cover all that later. But both of those criteria must be satisfied. And as mentioned by that third bullet point there, accordingly, there is nothing really wrong with identifying a superb structure, but then looking for somewhere reasonable to define risk at the level, especially if you're trading it blindly, which means not waiting for a reaction and just with limit orders or whatever else. Especially if you're trading it blindly, it's totally fine to at least wait, if not miss out entirely, on a trade if the structure is not very permissive when it comes to defining risk. There's no shame in that whatsoever. However, that doesn't just mean that if a structure doesn't immediately present itself in a way that allows you to define risk well, that we have to forego the trade and forget the level existed, right? And that's what the third bullet point is about. The core premise of this video is that instead of having to choose a stop loss after deciding on technical structure, sometimes the market does that for you. And it kind of offers a built-in invalidation level. And so we're going to be looking at ways to trade levels which may not immediately lend themselves well to defining risk, at least when coming into a blind. And we're going to look at overthrow as a way of rectifying that to some extent. And as I mentioned here, and we'll go over the benefits in more detail later, but a built-in invalidation level as provided by when overthrow occurs at a technical structure. It's easier to identify, it's easier to replicate, and also for those of you who are more on the quantitative side, even loosely, if you will, it removes a lot of discretion and makes collecting stats a lot easier, and that data itself more reliable as well. So, just to set the scene a little bit more, kind of what is overthrow, why does it exist, and what are we looking at? Markets are not clean, right? Even if you take common technical principles, so I've just taken one example here that support is support until it's broken, and once it is broken, it turns to resistance, right? Sounds easy enough. Now, think about that logically as almost casting aside everything else that you've learned to some extent. It would be very difficult to lose money if those two principles were true in virtually all cases, or even the overwhelming majority of cases, right? Think about it, because what would you do? Well, you're assuming you can choose half-decent levels of support and resistance, which you can from my other video, right, as an example. And so all you'd have to do to, make money forever and gain financial freedom, whatever other rubbish trading promises are made, is you buy support and sell resistance until it stops working. And the second it stops working, you don't even have to take a full stop out. You simply flip direction and make money on the other side as well. And losing becomes really difficult, right? Especially if you've got a wide stop and high time frames and so on and so forth. Now, hopefully, having heard that, that doesn't particularly equate with your experience in trading. And that is because what I've just outlined there is a caricature of how markets operate. If it were that simple, that support is always support until it isn't, and then when it isn't, it flips to resistance, and that's it, that applies 90, 95, 100% of the time, it would be very hard to lose any money trading, right? And obviously, it's very easy to lose money trading, and in fact, that's the status quo for, I suppose, newer traders or people entering the market, is they lose. So why does that happen if such simple technical principles exist? Well, it's because they don't always work, right? The technical principles outlined here, they're a guide, they're a framework, but they're not prescriptive or accurate in 100% of cases. Now, what we do with that information is you can either suck it up and play the 60, 70%, whatever number pulled out of my ass in the markets of your choice, or you can look to take advantage of the people rinsed and on the wrong side of the market when those technical principles fail to materialize, which is what we're doing in this video, right? As mentioned in bullet point number 3, all of the basic technical analysis stuff, tools, guides, frameworks, you name it, that we rely on, breakouts, breakdowns, as in, market structure, support resistance flips, chart patterns, trend lines, channels, supply demand zones, whatever you want to call anything, they are all likely at some point to not do their job perfectly. That is just simply how markets operate, right? And as per the last point, particularly markets that are heavily driven by speculation reflect the fact that traders get caught offside and are forced to make a decision, right? And we'll go into the kind of loose order flow aspect of that in more detail, but this is essentially why trap type of setups tend to unwind in such a volatile fashion. Traders have a straightforward technical expectation, as per the principles, of what a market is supposed to do. They position accordingly, and when, surprise, surprise, the market doesn't act like it should in a textbook 100% of the time, those people are then underwater and they're forced to choose what to do with their position, right? So this is kind of a framework to keep in mind, I think not just for overthrow stock placement, but for markets generally, that, we don't trade textbooks, we trade markets. And for there to be a market, the simple stuff should be interpreted as a guideline, framework, and a sort of base, as opposed to the holy grail, which will make you money forever. These things work until they don't, right? And it's a question of when they don't work, or when they don't quite work and trap people on the wrong side, are you going to be in a position to take advantage of that, or are you just going to keep losing money and moping that, oh, well, this was an amazing level of support, but then it didn't turn to resistance when it was broken, I must have had the wrong level, or the level's washed. That's all nonsense, right? You need to kind of embrace the chaos that these levels are there to be chopped up, be broken up, trap people, and you're not always going to get textbook price action. So what are you going to do about it? Well, hopefully something by the end of this video. So now that the backdrop, if you will, has been set, some more nuance on defining risk at a level. As mentioned in the... I'm not going to repeat this whole bit, obviously, because I gave it a lot of time in the general remarks, but technical structure on its own, in my view, is not enough to warrant a trade setup. And this comes to our two-part rule that, you know, the structure itself must be good, but it must also allow for logical stop placement. And what does logical stop placement mean? Well, something that's objective, replicable, and, you know, all of those sciencey terms, if you will, that we like to use. But specifically, for our charting purposes, it has a reference point, or something that you can replicate or track or rely on, as opposed to a kind of floating stop or a fixed arbitrary value. So, you know, there's a lot of resources in the risk management guide and in the different articles I've written on stop placement logic. But I tend to believe that your stop should reflect your trade idea, right? And your stop loss should be in a position where if it's hit, your trade idea is most likely no longer valid, right? That's why I've put fixed arbitrary value here. What you'll see a lot of poor trading educators do is come up with untested kind of mechanical strategies where they tell you to put a stop a certain percentage or a certain amount of pips away, or a certain position to get a specific risk reward, and that's all nonsense. In my view, the stop loss acts to kind of protect your trading idea. If your stop loss gets hit, your idea is wrong and you're out of the market. Simple stuff. And yeah, again, repeating the point that it's fine to not take a trade at a compelling structure, and so on and so forth, right? Now, identifying the technical structure is the easier part of those two branches or legs, whatever you want to call them. The difficult part is defining risk in a way that's logical and replicable, accurately invalidates the trade idea, which is what I was just talking about, and balances adequate risk-reward whilst not being a tight ass, right? That's all quite difficult to do, and I think, you know, people think that when it comes to trading, you just have to guess direction and then you'll make money. It's very easy to be right on direction, but not be able to position for that move properly. You know, missing limit orders, having a stop that's too tight, all these other factors which can adversely affect you and preclude you from making money, even if you are quote-unquote correct on direction. That is why, in general, if you're talking to people or following people on Twitter, whatever it may be, it's worth being slightly more demanding if they're parading as traders in terms of, I think the market's bullish, right? They haven't given an entry, haven't given a target, and there's no invalidation. The market goes up and they retweet saying, look, I'm such a genius. That's not what trading is, right? The difficult part is getting positioned and doing so in a risk-defined way that satisfies all these difficult parameters, right? So some healthy dollop of skepticism, perhaps. So what are one's options, right? When it comes to defining risk at a level where it may not be terribly straightforward. So you can wait for price to define risk for you, which is the focus of this lesson. You can miss the trade, which is fine. You can take a price action based entry, which is hopefully something that's familiar to you from the entry triggers video. And the last thing, again, this list of options is by no means exhaustive. It's just off the top of my head. And another thing you can do, which is, now that I think of it, probably going to be the subject of a future video, is enter at the next closest structure or break of first trouble area. Now what that simply means, just to give it 2 seconds of attention, if I've got level A, right, and then I've got level B, okay, and I'm bearish, and price hits level A, but I'm not sure how to define my risk at level A, you know, maybe it's the surrounding structure's ugly, whatever it may be, I'm going to look at where's the next closest level of support, and that's going to be level B, right, because it's below current price. So then what I'll wait for price to break down and break level B, and then I can use the price action at level A to define my risk getting positioned at B. Does that make sense? So A doesn't allow me to define my risk. I think, okay, well, I still think the level's going to do something. I'm just not sure how to position. I'm going to look at the next closest structure or first trouble area, which is B. And then once that breaks, I can then say, right, this is good evidence that this was the top. And I'm going to use the more recent price action at the level following a break of the first trouble area to define my risk. Hopefully that makes sense to some of you. If it doesn't, do not worry about it at all. As I said, it'll be the subject of a new video at some point. At this rate, once a month, but God knows. So Overthrow, we finally got into that portion of the video. Excellent. This term, I think I first heard it from Will Hunting when he's talking about trendline overthrow in one of his webinars from years ago. If you want to learn more about him, read my article on lessons from my trading mentors. But the definition, again, this isn't, Oxford English Dictionary. This is kind of stuff I make up at 3 a.m. So the definition of overthrow, as the name suggests, is when price exceeds a boundary of a technical structure and then falls back within it. So there are two elements to it, and we'll do the elements, I think, in the next, slide after next. But just looking at the phrasing there, price must first exceed a boundary, right? Have I got a pointer here? Oh, wonderful. Price must first exceed the boundary, that's part one, and then fall back within it. And only when it falls back within it do you have overthrow. Because technically, if you've got a structure and price breaks above it and just keeps going, that's obviously not any sort of trap or overthrow or whatever else. That's just a breakout. It's only when price falls back within it that we think of the, excess and presume it to be some sort of trap or whatever else. Now, this is not some new groundbreaking concept, right? You must have heard some of these technical terms before of a false break, fake out, bull or bear trap, deviation, pattern failure, reclaim. I'm sure I'm missing about 50, but essentially the same structure given different names, as is very often the case in technical analysis, right? Now, I think my personal view is that people fixate too much on the why of price, and then focus too little on the how, because you don't really trade the why, you trade the how, in my view anyway. But I think it's important to kind of give an outline regardless. And the question is, how does the whole technical trap or traders forced to make a decision, which was the argument made previously, apply to overthrow? How do those two things come together? And think about the chronology in this way. So if a trader is offside on a trade, which basically means on the wrong side of the market, they're forced to make a decision, right? So if I shorted a level and prices kept going up, I'm now losing money as price approaches my stop loss. So what are my options? And again, by no means is this list exhaustive. It's just it's here for our purposes. I can close at a loss, okay? I can do nothing and await my full size 1 hour stop out or liquidation, whatever. Or wait for the market to revisit entry price to close at break even or at a reduced loss, right? So if a lot of traders position the same way, and this is, I'm not going to go into the causes of crowded trades, but I mean, even the most basic example of some sort of big chart pattern on financial media that everyone's talking about, as is often the case in global markets. And then the markets take them offside. So those people who've tried to trade the common pattern or position are on the wrong side of it. As they puke, so as those traders close their positions at a loss, you'll know from the order flow video that shorts closing turn into, or market stops for short positions being triggered, turn into market orders to buy, right? So this is just kind of a bearish example. So, you know what? Let's look at one of the chart examples to present this. How about the euro dollar one? We will revisit these charts for different purposes. So just to give you an example there, you've got your beautiful 3-touch trend line, right? Price breaks out on this day, closes above, and let's say, you bought the close of that, so that's your entry. And then as price starts to drift down, and especially when you get the breakdown of this low here, even on an intraday basis, right? Your long position, as this breakdown is taking place, which obviously started here, is, it gets underwater a lot earlier than that, but certainly when you get that break of support or low, whatever, that's when you start sweating. And so in terms of choices, right, if you start closing your long position at a loss or getting liquidated, or your stop loss for a short being hit, stop loss for a long in this case being hit, that turns into a market short, which is what we see in the form of this accelerated downtrend. Because at this point, as price, probably when it's floating up here, it's a bit worrisome, but certainly when the low is broken on intraday basis, the breakout buyers are going to start feeling heat, especially assuming if they've got like a thrust candle stop kind of here below the low of the breakout day and price is plummeting towards it quite aggressively. there's going to be a lot of people puking those positions early, right? Anticipating or fearing, correctly in this case, that they've bought into a false break. Okay? So this kind of sums up what's been outlined in that slide. You've got a really obvious, importantly high time frame trend line. Every single FX blog in the world called, I assume, or at least in our hypothetical world, the breakout of a macro Euro USD trend line, super bullish. What are the retail traders going to do? I hate to use that term, but I suppose the masses, or what's the popular trade, the crowded trade? Well, you can just, long the breakout on the close of that day, and you put a stop below the engulfing candle, whatever the low of the day, right? Pretty simple trade. Crowded as hell, and as it starts to break down, right, it completely stalls after that. Notice, you got the breakout, nothing happens, no follow through, starts to stall, and then as the low goes, if you're a buyer up here, you're immediately underwater as soon as price even starts testing this low. And as it starts accelerating downwards, you start puking your longs. What is a puked long? Well, a puked long is a short at market, which simply accelerates the move down. And what also exacerbates this price action is that the more experienced traders will start to essentially capitalize on the fact that a lot of people are caught offside, on the wrong side of this move, and kind of pile in with their own size and positions and so on, right? So you've got two forces acting at the same time. We'll cover all this in more detail, so don't worry about it. But just for our purposes, offside on a trade, yeah, bought the breakout on the close of the day and the market starts dipping below our entry. A lot of traders position the same way, and the market trades them offside, they puke, right? Oops. Big trend line, obvious, all the financial news analysts, whatever, crowded trade. As it starts to shit, itchy hands, and you have to realize most people overmanage trades like hell, so I don't think many people are going to, as a general rule, wait for their actual ideas to get invalidated, especially on a daily time frame. Who's got the patience for that nowadays, right? And then as they puke, just the opposite in this case, their long positions closing out become shorts at market, which accelerates, exacerbates, whatever, the move down. So conceptually, a high volume of market orders, right? A high volume of market orders as traders puke and experienced traders take the other side with size is at least one kind of ingredient, if you will, of the kind of volatility we see on price charts. And it's worth bearing in mind that markets are often unforgiving, in the sense that offside positions are given little to no time to mitigate if the trap is real. And that's something we will talk about. But essentially, in a lot of markets, and this does vary, but certainly in fast-moving ones, if there is a trap type of setup that's supposed to induce people, I hate to use that kind of causative language, if the market doesn't do what it's quote-unquote supposed to, and a lot of traders end up on the wrong side, usually they won't be given much of a chance to puke at any sort of win or break even, whatever else. The moves tend to be volatile, as we'll see in the other chart examples. So the structures and elements of overthrow, again, just to reiterate the definition, when price exceeds a boundary of a technical structure and then falls back within it. So applying that to our Euro to USD example, obviously the trend line is our technical structure. It was exceeded in this portion, right? Certainly the first sign of it was the close above. And then the second element, so just to recap, element 1 is price exceeds the technical structure, right? Yes. Element 2 is the price then falls back within it, which happens on this daily close, right? And that means if we take our 1 and 2, so technical structure exceeds back within it, that means that the price action above the original technical structure after it has fallen back within it is your overthrow portion of the setup, which is basically this, right? If we do that again, let's use, why not, this Bitcoin 4-hour range or level. So obviously got small consolidation before another leg down, so like a mini range, resistance, whatever. Resistance. Okay, so that's our technical structure, obviously the level. 2 elements, exceeds it, falls back within. See the levels, very price sensitive here. Very much exceeded on this bar here. A few hours later, well, this is a lot more than a few hours, this is a 4-hour chart. But anyway, eventually, or quite soon after, falls back within it, within the technical structure on this candlestick. So what does that mean? Exceeds here, back below here, and so we know that this is the overthrow portion of the setup, right? And yeah, same for Swissy. I won't go over because the video will be too long if I do it for every single one, but I'm sure you get the gist or the rough idea, okay? Now, just a very quick note. Given that most technical structures have a boundary of some sort, including indicator stuff, I've not studied them in any great detail or in any detail whatsoever, if I'm being totally honest. I can't see why the logic wouldn't apply, but I recommend you go check it out and see how this type of these sorts of setups or this type of logic applies to your clouds, EMAs or ATRs, whatever you use, right? So then the question, what kind of structures are prone to being overthrown? What an amazing rhyme that is, right? And the answer is, well, any real structure with a boundary. So all the stuff that we trade and we talk about on this channel at the very least, horizontal SR, ranges, patterns, trend lines, market structure, any of all their variants. You've got your blocks, supply-demand zones, pivots, clusters, you name it. I think they are all prone to this type of price behavior, right? Which is a good thing because that means all of your regular setups can benefit from this lesson. So Overthrow 2, what are the structures and ingredients? We talked about some of them just a moment ago, but in more detail, or if you like a more chronological and crisp list. We've got a clear technical boundary formed as element 1. Element 2, price closes. Closes breaks through. Let's not do that. Price closes through the technical boundary, ideally impulsively. The third one, price stays reasonably close to the breakout point, which I'll elaborate upon in one of the next sections. And then price closes back within the technical boundary, ideally impulsively, right? So we're looking for impulsiveness on both sides of the break and the re-break, if you will. And interestingly, or well, maybe it's only interesting to me, but the second part, where price breaks back within the technical boundary, it doesn't have to occur immediately after the break, right? So the thing about the... it's not really a setup per se, but this logic is premised on the fact that there was supposed to be, a level was supposed to do A, but it didn't, right? And that doesn't have to be straight away or in the next candle or like in the next 15 minutes. It's to do with technical expectations. So on the daily chart, that can take more time. On an intraday chart, it can take less time. It doesn't need to be one candle up, one candle down, right? That's the point I'm trying to get across. And as we mentioned and highlighted in our examples, the price movement beyond the range boundary is the overthrow portion. And this is also the area that we'll be using for defining risk. So that's in our EURUSD example. I'm just going to go over it again very quickly. This is the boundary. What's the bit of price action took place above it before dropping back in? It was obviously this, right? Same for Bitcoin. What is the boundary? Well, the boundary is the range, right? The resistance. What's the price action that took above it only to dip back below? Well, it's here. So this is the overthrow portion, right? And you can see in these examples, something we'll also talk about, price often will come back to respect these levels, as it did in the past. So it comes back to retest this as resistance. This also gets retested as resistance. In all these, even I think Ethereum dollar in this case gets retested as resistance. And that's important to bear in mind because, well, it's important to bear in mind because markets are not clean, right? As you can see, if you took the view that every single support break is supposed to turn to resistance, and every single resistance break is supposed to turn to support, etc., a lot of these setups and a lot of these levels wouldn't make sense. And I used to think this way as well, certainly with the Bitcoin example. I think, oh, well, look, price broke my level one way and then broke it the other way, so I'm clearly, I've got the wrong level on my chart. That is not the case. That's kind of a level one interpretation, is that when price gets broken both ways, your level is wrong. I mean, sometimes it will be wrong, but a lot of the time, especially if you're dealing with clear, higher time frame areas, you should at least entertain the idea that your level selection is actually right, but the portion of price that didn't respect the boundaries was actually an overthrow in the making, as opposed to poor level selection on your behalf, right? Where were we? Cool, here. So, in terms of actual trades, now again, Overthrow is for stop placement, but of course, since it defines risk for you, it kind of results in a trade anyway, assuming the other parameters are in place. So just in case it wasn't explicitly clear, trades are taken in the opposite direction to the overthrow. So if you've got a failed break to the upside, when price falls back within the structure, who's on the wrong side of that move? Well, it's obviously the breakout buyers, right? And so when buyers are the ones feeling the heat, we want to ride that, and so we look to be sellers, right? Anticipating them to puke, unwind, and the more experienced traders to pile in the other side. Conversely, is conversely even the right word? Probably not. Anyway, the opposite is also true, or vice versa, I suppose. A failed break to the downside, and then price reclaims it, if you will, or rises back above the breakdown point. Who's going to be on the wrong side of price reclaiming a breakdown, or retracing in fully a breakdown in price? Well, obviously the breakout sellers are going to be shitting their pants as they see price essentially, zoom past their entry and a lot of buying below where they sold. And so we look to be buyers in that case, as we anticipate the offside sellers to unwind, puke, whatever it may be, right? And that should be obvious. So in this case, breakout to the upside and then breakout back down. Who ate shit on this candle? Well, it's the guys who bought. If buyers are eating shit, we like to be sellers. Same here. We've got resistance, we've got a breakout, and then it breaks back down below the level. Who's eating shit in the overthrow portion? Well, it's obviously the breakout buyers of this resistance level. If buyers are eating shit, we like to be sellers, etc., etc. Should be quite reasonable, I guess. This is the best word I can come up with. Or obvious. I don't like using obvious when teaching, but I suppose in this case it sort of is. Right? So, we know what overthrow is. We know what it looks like. We know which direction to get positioned in. We know what kind of structures will get overthrown. And we also know the kind of explanation as to why this sort of stuff works. And you also hopefully have a more nuanced perspective on price action, that a break above and a break below and price seemingly ignoring a level, at least in the short term, isn't a death sentence for that level. It doesn't mean that the level is no longer valid, right? And I'd strongly recommend, if you need further convincing of that argument, to watch my video on the support resistance trade setup. That is a trade setup that is entirely premised on levels getting mashed both ways before doing anything. So please go check that out, should you need further persuasion. So we've done overthrow, and so the title says using overthrow for stop placement. Having learnt all that, specifically having learnt which portion of price action is the overthrow portion, how do we then use it to define our risk? And there are two ways, as mentioned in the introduction. One is the furthermost deviation, and the second is a thrust candle stop. So we're going to start with the furthermost deviation. Definition is that risk is defined by the highest high or lowest low made when price exceeded the technical boundary. Now, obviously, for a sell setup, risk is defined by the highest high above the technical boundary, right? And then for a buy setup, the opposite is true. Risk is defined by the lowest low made below the technical boundary. Let's apply that to a couple of our charts. I will bring in some of these lads as well. Let's start from here, actually. No, let's not start from here. Nope, you know what? Let's go with what we're used to, and then I'm saving those examples for some other stuff. So in this case, we know the overthrow portion is here. What is the furthermost deviation? Right, we're looking for a sell setup. We're looking for the highest high made in the excess portion of the move. And that is obviously going to be here. Pretty straightforward, right? Let's look at this as well. What's our structure? Well, we know it's the level. We know this is the overthrow portion. And so the furthermost deviation within here is the highest high made, which is this high, right? We'll do one more. Oops. I am incompetent as ever. We've got a big level. Ethereum dollar, daily chart, right? Support, breakdown, resistance. This is actually a double close type of thing that's taught in the video, right? But if this is the level still, I mean, this is just kind of showing its origins. If you just pay attention to the price action here, right? You've got where are we? We've got resistance, price closes above the level, and then breaks back below it. So you've got, especially on the low time frames, it would be visible. You've got overthrow at the level here, right? Where its boundaries were exceeded and then price fell back within it. And what's the furthermost deviation of the excess? Well, it's obviously this high here. Hopefully you get the point by now. You can do this by yourself. In this case, you know, you've got the level, highest high made in the overthrow portion. Okay? Now, generally, this is the more conservative option, as it usually offers a wider stop, by definition, right? We're going for the lowest low made, highest high made. Now, there are obviously pros and cons, and some nuance and stuff you have to incorporate according to the market that you trade. But, general points, a furthermost deviation stop is less likely to get spiked on a retest of the level if there is one, right? So if you think about it, I suppose the simplest way, if I could just scribble on a chart somewhere. I mean, this is a decent example, to be honest with you. We've got Swissy dollar chart. Not Swissy dollar chart, Christ. Swissy daily chart, okay? And we've got the range high, multi-touch level, whatever. This is the overthrow portion, obviously. You've got excess, price exceeds the boundary, and then falls back within it, certainly on this candle. And you can see that in this case, it actually kind of flagged or pulled back to the level itself, right? Before continuing downwards. So in terms of furthermost deviation stop, it'd be all the way up here. But if you've got, for example, a thrust candle stop, which we'll learn next, that would have been on this high here, the day that broke the support structure. And you can see that pre-breakdown, you would have actually been knocked out of this trade and missed the move down, right? Or at least that specific setup would have been invalidated. And that's what I mean. So you can see the difference between the two setups. If you trade a market that likes to pull back to retest broken levels, even after a trap, the furthermost deviation stop a lot of the time is going to be much safer and more conservative, and the price you pay for that is a wider stop, so arguably or usually inferior risk reward in that case. Okay, and this kind of stuff, the thrust candle stop, we'll cover in the next section. But that's what I mean. Furthermost deviation stop, much safer than a tighter stop closer to the level. Hopefully that makes sense. So, as I say here, less likely to get spiked on a retest of the level, simply because it's further away, and as a result, more likely to offer worse risk reward. And the reason I say more likely as opposed to definitely is because, as it says in the final point, the furthermost deviation stop and thrust candle stop will not always be different, as per examples. So take, I think Ethereum dollar applies in that regard. Yes, it does. So we've got that same level. Where does the excess take place, or the overthrow? Takes place here. What's the furthermost deviation? This high. What's the high of the candle that broke price back within the level? Exact same price point, right? But obviously the exception doesn't make the rule. Generally, with furthermost deviation stops, you are going to have a wider stop. It's not purely technicals. There is very much a know your market and some discretionary stuff here involved. So, as mentioned, if your market often retests the overthrown structure or the level post-overthrow, stop placement is going to be more reasonable using furthermost deviation, so you avoid these types of Swissy scenarios, right? When it comes to retest, if you're too tight, higher chance that you get spiked out, whereas furthermost deviation more likely to keep you in, right? And the reason, and I think I talk about it in the next point, yeah, if thrust candle doesn't have much range, the stop placement is often more reasonable. So a thrust candle really has to be a thrust candle. If you've got price, I mean, all of these examples are good, but you'll often get the case that, just for illustrative purposes, you've got, let's say this is our level. You've got resistance, resistance, price comes up, does something, breaks down, right? Closes here, and then you get your alert and you look to get positioned, but then it turns out that the candle that took price back within the level was actually just barely closed within it. Like, you've got a very small candle with, let's say, even the worst case, like a flat top. In that case, you're basically putting your stop loss for a short at resistance, right? I suppose that's the clearest way I can articulate it. If you're using a thrust candle stop, or looking to use a thrust candle stop, and the candle itself doesn't have much of a range, right? doesn't have much of a range, it ends up being so close to the level that you're selling that you've essentially put your stop loss for a short at a level of resistance, which you should never do, right? That's what that point means there. And obviously, if that is the case, if there's no impulsiveness or no range, or basically the thrust candle is in some other way inappropriate for stop placement, that's when furthermost deviation can be more useful. And of course, if your market usually just shits on momentum after a trap, furthermost deviation could be seen as a bit of a wasted opportunity, and it may not be optimal, and such a wide stop may not be necessary. So a good example would be, yeah, let's take this Ripple dollar example, sure. This also shows a trend line overthrow, by the way, so we'll cover a couple of these. So for our purposes, the example we're talking about with furthermost deviation stops being somewhat quote-unquote wasteful is take this example up here. You've got, you know, market structure kind of poking up. You've got the higher high from this point. You've got higher low. You know, things are looking positive. You finally get the breakout, the higher high off a 3-touch level, pulls back, finds some support but doesn't do much, right? You'll notice that this price action itself hit a level of resistance, and then you've got a big bearish bar that completely nukes through the breakout level itself. I mean, this is an obvious thrust candle, very impulsive, big red body, you know, very uncontroversial in that regard. If you're using a furthermost deviation stop, you're all the way up here, whereas thrust candle, you're down here, right? And so, I mean, this isn't a market that I trade, but let's say I had enough evidence, statistics, data that XRP dollar doesn't come back to retest these sorts of, you know, these reclaimed structures or overthrown levels once they're broken. You can adjust accordingly and kind of pile in more size or have better risk reward by using the tighter stop than the wider stop, right? And this is just an example of a trend line overthrow. You can see multi-touch, 1, 2, 3, 3.5, 4. Levels broken. This is the lowest low made. It's reclaimed here, right? So if we use our normal stop loss parameters, let's zoom in on this a bit. We all have terrible eye strain anyway, I'm sure. So technically, this is our overthrow portion. Let's try out our 2 stop loss methods. One is the thrust candle that took price back within the trend line. It's low, which is here, and then the other one's the furthermost deviation here, right? And as you can see, and as mentioned in another section, there isn't always going to be a difference between furthermost deviation and thrust candle stop, and there certainly won't always be a massive difference between the two where you have to kind of, you know, do or die and commit to one. A lot of the time the structures will line up and give you roughly the same area. Now in this case, interestingly enough, this is kind of an example of real trading. In all the diagram examples, you know, it's reclaimed and then just goes straight to the moon, whereas in this case you see even trading an overthrow setup, price still dips back below the trend line and gives you some heat, but ultimately respects the lowest low made, and technically you've got, you know, low, higher low before doing its thing, right? So a couple of examples at work there, but to take us back to the point at hand, if you have a market which tends to really, you know, very momentum based and see a lot of follow through and no retracement, then a furthermost deviation stop may be quote unquote wasteful or not ideal if the chances of a retest are low, right? Now, thrust candle, you probably know just from the preceding section what it means, but risk is defined by the high-low of the candle that took price back within the technical boundary, right? So for a sell setup, it's defined by the high of the candle, and for a buy setup, it's the low of the candle. I'm sure I don't need to go over it, but let's do it anyway. So in the XRP dollar example, this is the structure as we talked about. What's the candle that took price back within it? Well, you see on these bars, it was still closing above, so that's no good. Whereas it finally closed below on this candle here. And so whereas it's high, this would be our stop placement for a thrust candle stop. And obviously there are no questions as to its impulsiveness, right? Is there a valid example here? I believe there is. Euro dollar 4-hour chart. You've got resistance, multi-touch support that's being respected the whole way, right? Then you can see, finally on this candle, the level is broken, okay? But to add some additional context, you can see that this low, this low, SFPs or spikes, the lowest low of this swing, so you've got a bit of another trap type of confluence or bullish confluence at the level, and then the next candle takes price all the way from this low and below this level to, I think, what even looks like a slightly higher high just in 4 hours. Yeah, so I mean, at that point, this is your thrust candle, right? And yeah, it's got a bit of a wick on it, but if you look at what it's achieved in terms of taking price from this close to this close and making an kind of a medium term, or I suppose it's very short term higher high in the process, quite clearly a thrust candle. Certainly if you compare its size to the preceding bars, it very clearly, in my view, stands out as sufficiently impulsive for our purposes. So level is fine, level is fine, level is fine, level is not fine. So this is the excess, right? This excess here. What's our thrust candle stop in this case? Well, this bar, as we know, took it back above the level. So its low is the thrust candle stop, and the furthermost deviation stop is this low here. So again, not the end of the world, but if you can get positioned, especially following this SFP, if you can get positioned slightly tighter on a convincing candle like this one, why not take the better risk reward, right? That's a thrust candle stop example. Covered this. Yeah, this one, the examples we talked about for Swissy. Technically, I mean, depends kind of how you draw this support level, but let's assume I've drawn it correctly. Not that there's necessarily such a thing. I'd say this bar is still within. This isn't the thrust candle. Why? Well, I would say that it bounced at this level here at this high, so it's still providing support in that case. And certainly the threshold for thrust candles is set quite high. We need to really break back within the structure, give us evidence of a trap, and be impulsive. So if it's respecting the lower boundary of a support level on a closing basis, that's obviously not good enough. We want it to be cleanly broken and price to be clearly back within the level. So we know blue is our structure, that's the overthrow portion. When does price really convincingly fall back within or below resistance in this case? I'd say it's this candle here, right? So that means this is our thrust candle, and where is its high for our stop? Well, it was here. And you will have got, you know, in this instance, you're spiked, you're probably out, and price dumps. Now, is this avoidable? Yes and no. No, in the sense that sometimes you'll just get cheesed by the market. It's how it works. You know, you take that risk when you elect to use a tighter stop. However, one thing that is within your control is whenever you're about to put a stop, you know, a stop loss order in the market, I recommend you completely wipe your charts, leave nothing else, and only your stop loss order as a level. And in this case, it would have been quite obvious that this is a terrible stop loss because it's still within a level of resistance. If you're bearish, if you're trying to short, do you want to be kicked out of a trade at a point where price might go down? Of course not, right? Because you're not wrong at that point. So typically when this sort of stuff happens, if you want to use a thrust candle stop, but you've delineated it and it looks like you've put it at support or at resistance, basically somewhere it shouldn't be, the simplest way to do is just to move a candle back, right? And see if circumstances change, right? And if it doesn't, you can move another candle back and reassess the risk reward. Okay? That's a really important point. Do not blindly plaster these invalidation levels or these stop loss orders onto your chart, assuming it's going to be perfectly fit every single time. Because that's when these sorts of things happen. At the very least, check whether you're stopping out at resistance at a short, which shouldn't be, or stopping out at support on a long, which also shouldn't be. If you are, adjust accordingly. And again, similar things from the last slide. Very much know your market. If it shits on momentum, stop placement, thrust candle stop placement may be more reasonable, as we saw on the XRP USD example. And for me personally, as I've droned on and implied a million times, I tend to avoid thrust candle stops unless the candle is clearly impulsive. Now, this is a very kind of loose discretionary category. I don't have any quantitative stuff for you, but the simple test is if you have to question or ask whether a candle is impulsive, it probably isn't, right? It's one of those smell tests type of things. But of course, there is stuff you can look at, as we did with the euro-dollar example. Specifically, how does what you think is a thrust candle compare to the preceding you know, to the candles before it, either in the same session, the same day, the same week. You can kind of use that kind of stuff for context. Candlesticks to some extent, if it's a big engulfing candle, then it's probably a valid thrust candle, all that kind of stuff to add context. But really, if you have to ask yourself and question it, hopefully all the examples that we've used are quite quote-unquote obvious, and that's how it should be in your analysis as well, right? If in doubt, leave it out. So, probability enhancers, things we can look for to increase the chances of this being a real trap setup or the stop placement specifically being valid. Well, high time frame trend, right? Always, for any technical analysis stuff you learn, trend is a very powerful addition. And the simplest way I can articulate that is expect false breakouts in a downtrend and expect false breakdowns in an uptrend, right? And looking at some of the chart examples is quite instructive here. So you can see, and you know, even the bigger picture, like the weekly and monthly view, Euro USD is trending down for quite a long time. And when you finally get a breakout, right, there are of course reasons to be cautious. And your caution is confirmed when price closes below the level and fails to flip it, right? Because if you're buying this breakout, you're getting very aggressively positioned in what's a higher time frame dominant downtrend. So it's worth at least being on the lookout for overthrow setups that form counter trend, because those are the ones that are going to work really well. It's more likely that you have that a breakout that takes place in a dominant downtrend is more likely to be bullshit than it is to be trend reversal. And if it is trend reversal, that's fine. You can tag on to the trend late or later, but presume, or at least maintain a healthy dose of skepticism when dealing with high time frame dominant trends, right? You're more likely to get trapped on the bullish side in a downtrend and more likely to get trapped on the bearish side on an uptrend. That's just, I think, how we are psychologically, always trying to fade and not trading the trend and all that kind of stuff. Be on the lookout. Yeah, so I mean, high time frame trend, obviously, you need to be cognizant of the type of market you're in and adjust your directional bias accordingly. That said, you don't really need to guess, right? Because even in the Euro USD example, like if you see this breakout, you're kind of like, okay, well, I'm going to have to see momentum continuation, or at least a flip of broken resistance to support to convince me that trend is going to reverse to some extent. So obviously, with that skepticism in mind, which is still totally reasonable, price hasn't exactly flown thousands of pips away from the level. When you see this candle, your fears are confirmed, and then you can get positioned and use the overthrow structure to your advantage, right? So you kind of don't need to guess anyway, because the overthrow is only confirmed once price falls back within the boundary, and at that point you're almost certainly correct on your read, assuming everything else is right. So same here. If you see that you've got a really bearish move in ETH USD, right? Lower low, the range is broken, retesting resistance, comes up and spikes the highs. When you see this daily close, you might be thinking, well, yeah, it's technically closed above the level, but it's just spiked all these highs and this isn't exactly a bullish candle, right? The trend, or at least market structure in this case, is still very much bearish. When you then see this candle that spikes previous day's high and takes price back below the structure, that's when your overthrow logic is confirmed and all the usual stuff kicks in, right? So high time frame trend, just know where to look for these setups. Another factor is the impulsive return after exceeding the technical boundary, right? I've said the word impulsive like a million times. It sounds like I'm teaching an Elliott wave course. But the more impulsive a move is, the greater the trap. Going back to our sort of pseudo order flow argument, offside positions have less time to mitigate. Well, this is redundant. If you're offside, of course you're losing, right? Excuse me. Let me amend this. To mitigate, okay? And if they're forced to decide more rashly, that's more market orders flooding as they try to scrape any sort of or reduce losses from the position as far as possible, right? Like if you get into a position, like I mean just purely hypothetically, right? You get this is a support level, price bounces, you get positioned like somewhere on this bounce. if price then retests the level and kind of starts bouncing about and showing evidence of weakness, you might be like, oh, okay, you know what, I'm going to cut this and reassess, and that's fine. The market participants in this time period get a lot of time to essentially change their minds at little cost, right? Because it's still floating around your entry. What we like to see is that same buyer who got in at this close, as the market starts shitting, right? I mean, this is a terrible example because it's not like an overthrow type of thing. So let me just fix that really quickly. Resistance, breakout, comes back, and let's say you buy the support resistance flip, right? If the market just kind of meanders around the level and doesn't do much and flirts at the boundary, that gives you plenty of time to close, and there isn't that rush and that flood of market orders of breakout buyers who got in on the break of this level puking. Compare that with price comes back, closes, and then immediately starts to shit through the boundary. Red P&Ls flashing everywhere, immediately underwater on the level that should have been support, right? That's what that sense of urgency and the urgency it creates by creating a quickly losing position is what floods the market, or at least one of the elements that floods the market with those closes. And we know that longs closing at market turn into shorts, and that's where we really get acceleration, right? So impulsiveness, people having less time to decide, is what we're looking for, right? That's really, from a technical point of view, what's indicative of a trap. Traders being forced to choose and forced to puke losing positions and aren't afforded the luxury of exiting break even. Okay? Accordingly, blah, 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 an overthrow setup is less likely to be valid if price floated, hung around the structure for a while, as per the stuff we talked about, right? Are there any amazing examples that I've missed in all of that? I don't really think so. We can check them out later if there's any need. Now, technical structure selection itself, you'll know from the, again, pseudo order flow, whatever you want to call it, section, that we're looking for crowding and then for basically urgency and decisions having to be made about those positions very quickly, right? Without the luxury of being able to cut it at break even and reassess. So popular, attractive, and crowded levels work best for this kind of stuff. The sort of stuff that stands out on the chart, that everyone's going to be looking at, that all your shitty, you know, financial media and crypto coin, whatever rubbish nonsense websites having their underpaid analysts write about. Those types of busy areas are the ones that really lend themselves best to these sorts of setups. And you know, the reasoning being that the higher participation results in a greater volume of unwinding when offside. And not to mention, as I said, while the blokes who are on the wrong side, the breakout buyers, breakout sellers, whatever, while they're feeling the heat and are shitting their pants that they're underwater and they're puking, the more experienced and the smarter traders are taking the other side of that trade, and hopefully you'll be part of that group, realizing who's trapped and taking advantage of the liquidity that they provide, right? And when it comes to technical structure selection, the only other point I'll make is use high time frames as a filter, or starting point at least. So high time frame support resistance, ranges, market structure, because again, simply because there will be more eyes and more trading at structures that are more visible. Final point about probability enhancers, tight overthrow, which basically means price, when it exceeds a boundary, doesn't completely fly away and then come back years later. I find that it's easier to define risk, and the setups generally work better where price did not greatly exceed the original technical boundary. Certainly when it comes to furthermost deviations. Like for thrust candles, it's still fine. For example, take this Bitcoin example. Let's say this breakout then took price all the way here, and then it only broke back below the level at this point. If you're using a furthermost deviation stop, that's kind of mental because it's going to be all the way up here. You can play around with it and say, oh, well, I'm going to use the last swing high before it broke down. But then, I mean, if you're happy to adjust and cater in that way, feel free. But I would say that generally setups, for me, don't work as amazingly when it's extremely rounded and far away from the level. And it also increases the chances that price is more likely to be reacting to something up here or further away from the level, and it might lose the present level might lose its significance to some extent, right? Obviously, for a thrust candle stop, it's still fine because it doesn't really matter whether price breaks back into the range here or here. But certainly, if you're using furthermost deviation stops, or if that's your preferred method. Tight, break above, break below, so this kind of stuff, you can see all these examples. It doesn't really take long for the unwinding to take place, at least in relative terms. In my experience, this stuff just works better. But that doesn't mean it doesn't work for the more extended moves. This is just kind of my opinion and something to play around with. Conclusion. Going back to square one, what we're essentially dealing with is that defining risk at a technical structure can be difficult and often ends up being at least somewhat arbitrary. That's the stuff we talked about fixed percentages and putting a stop in a certain place to get a certain risk reward and all this other malarkey that we are not interested in as technical traders. Overthrow allows you to remove a lot of the arbitrariness and discretion, right? So not only, and also kind of the benefit, as you'll hopefully have gained from the the flow side of things, is that it doesn't only define risk for you, but it also kind of gives you really good confluence for your setups, whatever technical structure you use, that hey, not only is this like support, resistance, whatever, but there is real good evidence. And by the way, that wasn't a grammatical mistake. I'm not saying real good. I'm saying real, good evidence that there are people trapped on the opposite side of your trade, which is always excellent news, right? As a general guideline, look for impulsive moves in price and ask yourself who is on the wrong end of it or what preceded it, right? So when you get range breakouts, breakdowns, chart patterns, all this kind of stuff, you need to ask who's getting rinsed. Now, this isn't always, it won't always be the case that a certain technical structure has been overthrown and you have to find it and every big red or big green candle is an overthrow. That's not how to think about this. Like, the basic principles of support is support, resistance, they flip and all that. It still works generally. This lesson is just to provide you with ammo and setups and a good way to define risk when it doesn't work. So instead of holding your dick in your hands, doing nothing and complaining that a level's been washed or the support resistance flip failed, you can actually do something about it and your setups can thrive even in those environments. The penultimate point is something that I've alluded to I think at the beginning of the video. It will take some getting used to, because it's a different way of looking at charts. We're used to clean levels, and when they're broken, they flip, and you get continuation, blah, blah, blah. And it is very counterintuitive to see a level get chopped one way, chopped the other way, and then still derive some sort of significance from it. I certainly used to think that if I saw two candle closes through a level, so one below, one above, or one above, one below, I used to see that as a death sentence for the level, and that it's over, and I've clearly chosen the wrong anchor. That's not the case, and you need to get into the habit of avoiding the tendency to call a level or structure washed. Right? I'd say watch the support resistance trade setup video because I elaborate on this a bit more, but broadly speaking, let's say we've got this resistance, you've got resistance, it's kind of proving itself as a level at this point, then it breaks above and breaks below, right? I used to think that, these two things put together, break above, break below, would be evidence that I've chosen the wrong level, but it's already proven itself here, right? With these two big swing touches, and so when it comes back, a lot of the time, you'll find that it kind of restores its original purpose and acts as resistance. So this, a washed level, a double close, a washed level does not make, right? What a washed level actually looks like, I think, is when you lose price sensitivity, and, I suppose that kind of encompasses both points I was going to make. When you lose price sensitivity and price is happy to stick to a level and chop it both ways and not swing away from it and basically it becomes untradeable, that's a washed level, a continued or sustained period of a total or near total absence of price sensitivity at a level. Yeah, at that point then maybe you've got something wrong, but if you've got an otherwise nice level that just gets closed above, closed below, try to train your mind to think about that as a false break, or think who's on the wrong side of that level, as opposed to, oh well, that's it, the level's done, there's nothing good there. This isn't a setup per se, because, we've used all sorts of examples like ranges, trend lines, levels, and so on. We haven't talked about take profits or any of the other stuff that would typically feature in a setup video. But you can certainly, the whole point is you can build it in or build your setups around this sort of principle and still make money when the obvious TA technical principles don't work. And if you want some further guidance on that, hopefully you've watched these videos by now, but entry triggers, and horizontal SR and SR setup videos, all those three will be quite instructive in that regard. Technical Roundup. Look, I don't have a big marketing shtick. My great colleague Donald and I write a weekly newsletter for crypto. We do Bitcoin, altcoins. Ends up being about 30 odd pages every single week. Every single Tuesday at 8 o'clock UTC, PM that is. We send it out. Constant improvements. You know what? It's very popular to rely on, oh, I've done so much, I've done all these videos. I don't really expect you to care. I'm just telling you, this product exists. We think it's sick, and I'd love for you to check it out instead of any type of donation, tips, whatever. There's no sleazy sign-up nonsense. Just go on the website, and there's a big button called Preview, and you can just read. It'll just open a PDF in a new tab. You can read an entire unredacted newsletter from a couple weeks ago and see if it's your cup of tea. If it isn't, that's cool. Obviously, it hasn't interfered with my content creation, and I very much appreciate your audience for that. Usual stuff, please leave a like, comment, feedback, all of that's wonderful engagement, and I will see you for the next video. But do check out technicalroundup.com, read the preview. We do a lot of cool stuff there. And as mentioned, before I head off, I think it'd be a good idea to make a video on this. Taking a trade at the nearest structure or trouble area as opposed to at the level itself. That might be a nice little addition to this one. Okay, thank you very much for your attention. Leave a like, subscribe, all this other good stuff, and I will see you next time.